Good morning, everybody. Paul here, coming at you with a Crypto Coffee update where we're going to talk about all of the exciting news and conferences and events that are happening here in the crypto space. And before we get into any of that, I do ask you if you'll please join me for a ceremonious simultaneous sip where we just turn the bottom up for our cup and enjoy a sip of coffee together in solidarity to start the episode right. So, join me. Good stuff. I always wondered why bottoms up was a thing, because if I turn the cup all the way up, I'll just spill hot coffee all over myself, but I guess colloquialisms are what they are for a reason, historical precedent, which is something we'll be taking a look at today. But before we get into that, we have cryptide.cc, which is our lovely website, and I would implore you to check it out at your convenience to get a take on all of the exciting information that we talk about here, and even more pieces of news that I happen to peruse throughout the day that I want to share with you, the dear user. All right, with that out of the way, let's get into your featured presentation, which, as said, is some exciting mechanisms relating to ETFs and government institutions. Now, ETFs are all the rage. They're the talk of the town in the crypto world. How are we going to get institutional investment excited about Bitcoin? And perhaps one of the best ways to do so is by giving institutional investors exposure to the underlying digital asset without actually having to own it. In other words, a derivative. Now, Reality Shares ETF Trust, which is a division of Blockforce Capital, attempted to do just that recently before the SEC issued a formal request that said, hey, will you please voluntarily withdraw this proposal? It's not going to work. And there's a particular reason as to why. A lawyer for Reality Shares says that it's not appropriate to file a registered 40 Act fund with cryptocurrency exposure at this time, as per the SEC. Now, this is the Investment Company Act of 1940 that the lawyer is referring to, and it has a very important and specific caveat that the SEC assumingly was focusing on when they requested that this ETF proposal be withdrawn. And that is the fact that any proposal that is not explicitly denied automatically becomes approved within 75 days of submission. And you can see even in the article, it is a specific aspect with which the SEC staffers took issue. And that makes sense, considering that these digital assets are comparatively new and it's still being sussed out how existing precedents and law apply to these new digital assets. Any kind of automatic approval of an ETF could have potential unexpected or maybe even unwanted implications from a judicial perspective. So reasonably, I think this was a good demonstration, not only from the SEC, but also from Reality Shares, ETF Trusts, and Blockforce Capital, to kind of see it from the side of the SEC and not try and force through an ETF or ask the SEC to go ahead and take the time to review this and more than likely deny the ETF, leaving a bad taste in everyone's mouth, not only individual crypto investors from retail to institutional level, but also assumingly Blockforce Capital, who would not see the passing of this ETF, and the SEC, who would have to detract important man hours and put it into researching an ETF that largely is slated to already fail due to the fact that an Act 40 fund with crypto exposure at this time is not really warranted, and that's their position. Now they're sticking to it. Now this is only one angle of attack that ETFs are undertaking to try and get a Bitcoin ETF passed and greenlit by the SEC. Now, one CFTC official is arguing, however, that some of the dissenting opinions about the ETFs that have already been rubber stamped and denied doesn't hold water due to some specific implications that are already being used in practice that could reasonably apply to Bitcoin as well. This individual, Brian Quintens, who is a commissioner at the U.S. Commodity Futures Trading Commission, or CFTC, to avoid having to say that whole mouthful every time, he's saying that there are already mechanisms to avoid price manipulation, which is really a huge point of contention the SEC has taken with any existing Bitcoin ETF. One mechanism that the CFTC is already utilizing for their Bitcoin ETF is essentially having, quote, multiple volume weighted average prices in 5-minute increments over the course of an hour across multiple exchanges. Also a bit of a mouthful, so said another way, there's multiple exchanges, a collection of them, let's say 10 of them total, through which the average price of the futures contract or ETF is weighted. And also, this is not just from one snapshot, this is within a 1 hour period in 5-minute increments, meaning 12 different points of data from 10 different exchanges, assumingly, let's just use that as a hypothetical, for a total of round about 120 different data points by which an average price can be discerned. So this is a huge innovative mechanism by which any kind of manipulation not only would be dissuaded, but the cost of said manipulation would increase markedly. Not only that, it would be very evident as to what's happening if manipulation were to be undertaken. You can see here, quote, they would have to have the majority of volume on multiple exchanges in multiple 5-minute periods. Could they do it? Maybe. Again, let's consider Sylvian Ribe's analysis where he talked about varying volume in exchanges and how price manipulation was almost assured given how unnatural the volume looked. What do we know about it? Immediately. So, even if this kind of manipulation were to be undertaken, the CFTC would know about it near immediately and assumingly be able to take some kind of enforcement action against the individuals who had perhaps some kind of probable reasoning to do so. So while this isn't a perfect solution, it is a unique solution that perhaps the SEC could begin to use as precedent, taking a leaf out of the CFTC's book and applying a more robust statistical analysis of underlying price for any associated ETF. Again, this is just one angle of attack, one particular way by which the CFTC is looking to solve a Bitcoin ETF issue, and I'm sure many of you out there have considered your own unique approaches, so let me know about those below in the comments, and let me know if you think that this is a healthy approach, that the SEC is taking seemingly their sweet time to delve into all of this information about how existing laws apply to a potential Bitcoin ETF, seeking guidance from existing ETFs via the CFTC, and trying to suss out new judicial action to see how to best navigate this exciting new technology. All kinds of implications coming out of government all the time. And this doesn't mean that institutional investors are just kind of sitting back, twiddling their thumbs, not doing anything in particular. They are actively entering into the crypto space, and that's something that Grayscale has been able to demonstrate clearly in their Q4 2018 report. Essentially, institutional investors provided 66% of total capital inflows into the crypto space, which is almost a supermajority. You can see here that 99% of investors in Q4 came from the United States, whereas a full year of statistical data demonstrates that about 33% were from offshore, and only, I say only, 67%, still a supermajority, were based in the United States. So this goes to show that institutional investment is happening with or without an ETF. There are plenty of mechanisms by which large wealth, high net worth, large capital holding individuals could in turn gain access to the crypto markets. And as said, they're definitely not just sitting around waiting for some kind of guidance from a governmental entity per se. The total investments were nearly twice the inflows of the previous 4 years combined. I think this is huge. This is kind of the big takeaway from the article from my mentality, watching year over year how the crypto space evolves. And seeing nearly twice the inflows of the last 4 years combined means that we're almost seeing a kind of parabolic rise of institutional money and how it's interacting with the space. And again, this is just stuff that is reported. This is assumingly a bit opaque due to the fact that over-the-counter deals are occurring. Perhaps even with some individuals, various kind of intentionally opaque trades of crypto as to not give some kind of competitive edge to their competitors by divulging information as to how much and when they're investing into these crypto digital assets. But nonetheless, this is only from Grayscale, so one has to wonder how much is happening behind the scenes. But nonetheless, the fact that it's more than twice the last 4 years combined, really kind of hammers the point home that institutional investors are indeed entering into the space. And that's not too surprising considering that JP Morgan Chase has just launched its own cryptocurrency, JPM coin, which is realistically something that I don't think a lot of individuals in the crypto space at present understand the gravity of in terms of its implications. JP Morgan moves more than $6 trillion around the world each day. For comparison, the total crypto market cap in the 2017 bull run went just over 800 billion, so that means that literally less than 12% of the total amount of money that JP Morgan moves around daily was the all-time high for the total crypto market cap. So we're seeing just mind-boggling amounts of capital interacting with this technology, perhaps not existing crypto projects. Again, remember, James Dimon is not a fan of Bitcoin per se. However, the underlying technology seems to be another matter entirely. The idea that there's so much liquidity being moved around that transferring dollars ultimately opens up any institution to some of the technical issues that could be associated with transferring such large amounts of money. You're going to have human error, you're going to have technical error. So having a token that is a representative value of $1 that could be utilized as a not mechanism to settle payment finally, but essentially a placeholder for what eventually will be a transfer of underlying US dollars to the entity in question, could cut down heavily on the actualized loss associated with moving around so much money. So to quote the head of JP Morgan's blockchain project, so anything that currently exists in the world as that moves onto the blockchain, this would be the payment leg for that transaction. The applications are frankly quite endless. Anything where you have a distributed ledger which involves corporations or institutions can use this. So really any group or institution associated with JP Morgan's banking arm, which is gargantuan, can utilize an underlying distributed ledger for settling payments, perhaps not settling them in terms of finality, but representing at least the underlying amount of value that is owed to or is owed by another entity in the network. So said another way, money sloshes back and forth all over the world in a large enterprise. Is there a way to ensure that a subsidiary can represent cash on the balance sheet without having to actually wire it to the unit? That way they can consolidate their money and probably get better rates for it. So that's much more succinct than the than the terminology that I'm trying to use here to convey how this settlement ultimately works. And Farouk does a great job in breaking this down. Essentially, you don't actually have to wire the cash. It just represents cash on your balance sheet. This sounds relatively simple, but again, when you're dealing with $6 trillion moving around every single day, it's not as simple as it may seem on the surface. So this is a huge move, something that I don't think can be overstated, and something that I don't think we're going to see the full implications of for another couple of months, maybe even a whole year, as this project begins to see the light of day and roll out in earnest, since after all, this is really only being utilized at present between huge existing clients of JP Morgan. Trying to find it here. Yeah, here it is. Big institutional clients for JP Morgan that have undergone regulatory checks like corporations, banks, and broker-dealers. So this isn't for your retail client yet. This is really for huge entities that settle lots of money every day. So we'll keep an eye out over the next coming months and over the next year to see exactly what this means. But again, can't overstate the implications here. Exciting stuff. Now, Coinbase is another huge entity in the space. Definitely isn't moving $6 trillion a day around. And perhaps they won't be moving a huge amount of capital in the foreseeable future if something happens to this cloud. You'll see what I'm talking about here in a minute. Essentially, Coinbase wants to store your private keys on Google Drive on a cloud backup. And this is something that sounds great on the surface. It's like, hey, it's backed up using an encrypted AES 256 GCM encryption. It's going to be stored and only accessible on your Coinbase Wallet mobile app. So things will be fine. We're just going to put your private keys on the cloud. And again, this is another thing I can't overstate how dangerous this can be. Even though it's a huge institution, what they're doing is essentially collecting huge amounts of passwords and critical pieces of information in one location on a Chinese server farm somewhere. That's not necessarily best security practices by any stretch of the imagination, and this is absolutely something that you can see here in the comments. Private keys in a centralized server? I'll pass. I don't understand. How do you misunderstand your target audience so badly? Just a lot of GIFs talking about how this isn't a good move. Yeah, it just here's a funny water bottle, one spray bottle. Like, no, get out of here. And this is something that is severely against best practices. We talk about a lot about not your keys, not your coins. And while you're going to have to interact with exchanges perhaps at some point, and you're going to have fiat onboarding, exchanging your US dollars or euro for Bitcoin or crypto, storing your actual private keys on the cloud is so dangerous. It's hard to overstate. Any security breach ultimately leaves you open to a transfer of funds um, that you don't agree to, which ultimately means you can't get them back. Again, there's no federal insurance for this kind of thing. Coinbase would essentially be on the hook for crediting individual investors their capital back. And not saying that they're not going through security practices that are robust and strong, but realistically, this is about incentives. And any giant pot of private keys that is essentially just overflowing to the brim with financial information, juicy financial information, perhaps hundreds of millions of dollars worth of user funds, and all you got to do is get into that vault. Individuals that are not well-meaning from all around the world will assumingly be very, very enticed to interact with that data set. And you can see here, this is the actual Coinbase blog. No one's happy about this. Everyone's saying this is pretty shocking. I'm a community manager for a few crypto projects. I've talked to people who lost their funds from keeping private keys on cloud storage. Why would you recommend this and even have it in-app notification to let people do this? Please tell me there's something I'm missing. Some people think this is a phishing attempt or sarcasm. It's not a good security practice, and the fact that Coinbase is trying to deliver crypto to the masses, to all people all around the globe, one has to wonder, to what degree is this an earnest attempt to square the circle of accessibility, usability for the average user, and a compromisation, perhaps, I guess I could say, basically compromising user security and the actual entire point of crypto, which is self-sovereignty to a reasonable degree. Of course, not all users are going to have the technical expertise and understanding to interact with the clunky, and indeed it is very difficult to use, crypto space at present. But we have to ask ourselves it's a very important question. At what point does user security become the responsibility of the individual? And at what point are we compromising the entire point of the ecosystem in and of itself for the sake of onboarding users in a way that, while easy, is perhaps maybe too easy if it compromises that level of security? Really no clear answers here, no clear-cut yes or no, good or bad stance that can be taken at this time, but I'm really curious, what do you guys think? It seems as though the crowd has spoken in terms of a no-go for them, at least, but do you think that this could be something beneficial for maybe a mom and pop shop or grandma or grandpa to access and diversify their crypto portfolio? Or perhaps maybe this isn't the best approach. If that's the case, maybe they would want to use something more like an ETF, using their financial advisor or manager. Realistically, again, no clear answer. Let me know what you think below in the comments. Now, one thing's for sure, Wyoming, all 12 people there are super stoked. Just kidding, there's more than 12 people. I think there's about 85 that live in Wyoming, are very excited for this new bill that is being allegedly passed. It passed the Senate, SF-125, which means blockchain companies will probably want to flock to Wyoming first, according to Caitlin Long. But the implications of this bill mean that the individual ownership, direct ownership of digital assets are recognized in the state of Wyoming. I hate whenever I do this, it gives me this little search copy, send to my flow, whatever that is thing. Makes it difficult to navigate. But yeah, the meat of the matter is Wyoming now recognizes direct ownership of digital assets if the bill is signed into law by the governor. So this is something that reasonably has been, for all intents and purposes, worked through. It looks good to go from the legislative perspective. However, it has to actually go through the executive, which is the governorship of the state of Wyoming, to see if this does become law. And if so, this is a huge precedent, because property rights are governed by the states in the United States and not the federal government, meaning that this has huge implications for Wyoming in particular, and perhaps some of the legal precedents that we've talked about previously, and how other states may begin looking at cryptocurrency and how to interpret ownership of the underlying digital asset. Here's an actual article talking about it, and I wanted to use this to kind of highlight some of the dangers in crypto journalism and reporting, and why kind of taking it at face value and immediately without doing more research can ultimately lead to perhaps some misunderstandings, whether intentionally misleading or really just that, an honest misunderstanding. You can see that I outlined the fact that this needs to be signed into law by the governor, and some of the implications about the law itself. It's not technically law yet. It's really just a proposal. However, this article says that it becomes the first state to give Bitcoin owners full property rights. I'm not trying to pick on Esther Kim here. Again, this is something that I've seen countless times in crypto journalism, is it moves so fast. So reasonably, while it's important to work fast and hard to get this information in the hands of the people as quickly as possible, that means that you almost have to doubly assure the quality just because that raises the propensity for misreporting. Essentially, the Senate did pass this bill, so she's accurate there, and she does go into talking about how it does need to be passed by the governor himself and eventually signed into law formally. However, to say that it becomes the first state to give Bitcoin owners full property rights is a bit misleading, so I just wanted to use this as an example to highlight why reading beyond the title, reading the article, and really looking at the source material is super important for getting a more holistic and objective understanding as to what is actually happening. And of course, that's why you got me, guys, Paul here, trying to help you out, get a better understanding as to what's going on, but I'm only human and I make mistakes as well. So just wanted to show you kind of my best practice and how I approach this kind of stuff. Now, Binance, we talked about them last time. We had some speculation as to some of their business practices, whether they were earnest or whether they were a bit unscrupulous. It could go either way. But one thing's for sure, Binance is absolutely delisting these coins here. I'm bringing this up for example purposes, again, just to kind of highlight research and show you kind of what I do. But yeah, also to keep you up to date, that Cloak, Mod, Salt, Sub, and Wings are all coins that are being delisted from Binance due to low volume. They don't meet the community standards that Binance has set forth, etc. And people are both shocked and sad because Sub was recently delisted from KuCoin as well. So both Binance and KuCoin are delisting Substratum. So kind of a double hit, 1-2 double whammy against the Substratum community and team, which has already had some interesting scrutiny surrounding it. That's kind of what I wanted to use this announcement for, a segue into talking about some of these coins from 2017 that were just absolutely celebrated, voraciously rose to near the top of the charts before piddling off into obscurity, and that's just kind of how bubbles work. It's really how these cycles of bull and bear markets ultimately affect these projects. If you look back in 2013, Feather Coin was near the top. There were some other ones. Barbecue Coin was listed, good old Barbecue Coin. I'll never be able to redeem those barbecue coins for delicious racks of ribs, but that's okay, because as the community in crypto space grows, I think I can stand to take a few hits in terms of no ribs for the ultimate betterment of human finance. Now, Substratum, they were talking about day trading ICO funds. I don't actually have a red flag big enough to wave to give you an idea of what this means. Essentially, they wanted to take funds that were raised for the project and for development and ultimately day trade them in a speculative manner in a market that is largely manipulated. This was back in December 17th of 2018, and the reaction was ranging from, is this a joke, to, are you serious, to, I'm already consulting with my lawyer. So needless to say, people were not happy about this, and perhaps the overall sentiment would have shifted if things went well, but ultimately what happened is they shorted ETH at the bottom. So essentially when Ethereum hit the absolute bottom, that's when the Substratum investor team day trading group said, hey, we're going to put a short call in on Ethereum, and ultimately that didn't go well. So they lost more money than they gained with this strategy, which was never the intent for the funds in the first place. So perhaps deserving scrutiny. Not only that, they faced scam accusations due to faking GitHub numbers. This is shortly before they decided to start day trading. A tweet came out saying that, hey, we have nearly 2 million lines of code and we have 173 feature commits. Things are going great. Turns out that's actually 62 times the number of actual commits in Substratum. So they inflated these numbers insanely. Definitely not 2 million lines of code, something closer to 32,000. So definitely not a good look for the company, not a good look for the community. And one has to wonder, why even use the metric of code? For instance, having more lines of code does not mean something's necessarily good. I love this quote from Bill Gates in the article. He said that measuring programming progress using lines of code is like measuring an aircraft building progress. Using weight doesn't necessarily equate in that way. And I wanted to use this as well as an example of some of the research that I undertake on a daily basis. Some users are saying that Substratum has a similar minting contract to Oyster Pearl. This is something that, based on the sentiment of the article, could have potentially be taken at face value, but it definitely needed more research behind it. So I went ahead and popped open on etherscan.io the contract for Substratum and the contract for Oyster Pearl. We actually covered, if you remember, in the Crypto Coffee update, Oyster Pearl talked about some of the specific implications. It was line 13, I believe. Yep, sale closed true, and line 18, if I remember. Yep, director lock false. So the sale was over, but the director lock was off, so the director could influence overall the amount of tokens that were created. The owner of Oyster Pearl minted a ton of them and made out like a bandit, essentially pump and dumping and exit scamming his project. So that's no good. And similar accusations, and they're just accusations, are being levied against Substratum. Who's to say if they're true or not? So we're going to take a look at the code here of the actual smart contract, of which I'm not an expert at, so I'm really going to rely on you guys here to discern whether or not this is true, because I don't see the same thing here. I don't see director lock false. I see is owner false, but the actual implications of that I can't necessarily suss out, as it's not my area of expertise. And I could basically make extrapolations and assert that I know what I'm talking about here, but I'm not going to, because really it's all about integrity and doing your own research and being forthright. As was said by, it wasn't Marcus Aurelius, who was it? Seneca, I think. One of the Romans of the time essentially said, no, always know what you say, but don't always say what you know. So with that said, I don't know this. I'm not going to claim that I do. So if any of you out there are very well versed in these kind of smart contract codes, let me know. Is this something to be worried about? Is this something that we should have concern about? And if so, perhaps we should start raising some alarms to corroborate this information that indeed there is a potential for an exit scam at Substratum. Not saying there is, it's not conclusive. I need an extra pair of eyes to verify that. But with that in mind, thank you guys so much for watching. That's all the information we have today. I hope you enjoyed this episode. I certainly enjoyed covering all this information. There was a lot. I know it was a huge kind of all over the board episode, but lots of implications to be had here, specifically on the subject of institutional investors like JP Morgan and the 99% of US institutional money that's been just pouring into the space. I mean, if we're going to end on one note, remember that the last year, 2018, saw nearly twice the amount of institutional inflows during the last 4 years combined. So we're moving, guys. We're moving. It may not seem like it day over day, but now is the time to build and research. And after all, what better place to do that than Cryptide? So join me in the Discord. Link below in the description. Thanks so much for watching, guys. My name is Paul. We are Cryptide, and remember, the tide is rising by millions and millions and millions of dollars, it seems.